Things that advisors should look at with hedge funds. First thing is recognize that the great returns were in the 90s. So classically, investors look at hedge fund returns over, say, 15 years and they take the average annual return. But in the 90s, that's when investors did really well. There just weren't that many investors. As money has come into the strategies, returns have gone down. So there's a very clear phenomenon of small hedge funds doing better than big ones. Any big hedge fund you look at, typically better when it was smaller. And many advisors and investors miss the third step, which is that the industry was also better when it was smaller. So I think that it's very important to focus on that issue of size and to look for strategies, frankly, that are less well trafficked, that are off the beaten track, a little bit obscure, where there's less competition, where the manager has more opportunity to generate outsized returns without other people crowding him out. And there are, of course, a lot of new opportunities to invest in hedge funds through 40 Act funds and other sort of listed vehicles. And I think that the key is to take each individual investment and evaluate it on its own merits. A big mistake I think investors make is to have a diversified portfolio of hedge funds. Diversification is a great thing when the asset class is going to have a positive return. But I found that the average dollar invested in hedge funds would have been better off in treasury bills. The average return is a bad thing. The only way to win with hedge funds is to be good at manager selection. If you are, then it makes sense to have a small number of hedge funds where you really have high conviction and where your skill of picking managers comes through. Obviously, you don't put 20% of your clients' assets in 2 or 3 hedge funds. You put in 1 or 2%. So really, I think the key is hedge funds have a role in a portfolio, but a much smaller one than you might think. Here's the challenge, and I ran a panel at another conference a few months ago, and I had some hedge fund investors on that panel, and I asked them this simple question. There's $2 trillion in assets. What's your average expected return for the industry? And the answer is 7%. 7% on $2 trillion is $140 billion a year in profit after fees, about $200 billion before fees, and the hedge fund industry has never made that much money ever, other than in 2009, when it bounced back from losing $500 billion in 2008. So today's hedge fund industry is overcapitalized. It has more assets than it can usefully invest to make the kinds of returns that investors are looking for. So I'd be very wary of allowing hedge funds to be too big a part of anybody's portfolio today.